Hello and welcome to today's webinar recording for the ASX Top 50 Video Market Update, February 2018. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances, and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, Managing Director of Investor Signals, have over 22 years of experience in the financial services industry. The topics for today, we look at the global macro driving equities. We roll through the ASX Top 50 with a look at FY18 and FY19 earnings, including PE ratios and dividend forecasts. We conclude with the model portfolio holdings and the market outlook. The big shift in equities has been the increase around inflation and the probability of the Federal Reserve doing 4 rate hikes this year and possibly another 4 next year. The reality of what's been priced in is a minimum of 2 rate rises this year and about a 75% chance of a third rate rise, and the 4th rate rise is only running at around 25%. But that change in interest rate expectations over the course of 2018 has been enough to cause a spike in volatility in global equities. And up on screen here we can see the Dow Jones fell over 10% from its highs to its low, and it's now rebounding into a range that's almost 50% of that range that it sold off. So from a pure technical analysis standpoint, that's pretty much expected when you get a bounce back up to about 50% of the range that it's travelled from, and we'd expect to see the index run into some level of resistance. And it'll be a real test for the market to see obviously how price action behaves around this 25,000 level on the Dow. Let's have a quick look at the ASX 200 or the XJO. And see how the price action is here. So we've broken through the 6,000 support, come down, tested 5,800, and we're not quite recovering at the same pace as the US equity market. We'd need to see the ASX back up testing around that 6,000 level, so another 100 points higher from where it is, before we'd be running into sort of that same resistance at sort of 50% of that prior range. Looking at the top 50 stocks, AGL, so our algo engine, so the AGL's in the model portfolio at the moment. So this is an example of an infrastructure name that has sold off the back of a combination of the company providing a slightly more tepid outlook for earnings over the next 12 to 24 months, but also with it being an interest rate sensitive name in the infrastructure sector, or the utility sector, I should say. But at around $21, we think AGL is very good value, and we've been adding it into client portfolios. The company should deliver about 8 to 10% earnings growth, and the stock's trading now on about a 5.2% dividend yield. We're looking for the stock to trade back up to around $23, and we recommend selling covered calls over AGL. Aristocrat Leisure, so you can see here this is a real momentum play. It's one of the best performing stocks in the model portfolio, and it's continuing to make higher high and higher low, with support there at around $22. The stock is expensive, 23 times earnings on a 1.7% dividend yield, but the market's looking for ongoing earnings growth at around 18 to 20%. Amcor, so this name disappointed a little bit in the latest earnings update, but it's been a while since we've seen the stock back on a 16 times multiple and a 4.5% dividend yield. So it still remains in our model portfolio as a long or a buy position, and we think investors should keep an eye on it as it approaches this support level down at this range here. AMP, so this is a stock that sits in the model. We had algo buy signal here at around $5, and the company continues to make a higher high, higher low. The earnings result was a little uninspiring, and AMP trades 15 times earnings on a 5.5% dividend yield. And on a forward basis, the market's looking for about 3 to 5% earnings growth. The ANZ, so interestingly, all the banks now currently sit in the model portfolio. So we'll wait and see how this plays out over the coming months. But the banking results are really reaffirming what we all expected, which is the banks will have a tough time growing top-line revenue. Cost control was a big part of meeting their earnings guidance, and also low bad debt provisioning has helped the banks to meet their expected earnings numbers. APA Group, yield-sensitive name, it was removed from the model up here at 950, and the stock's continuing to fall away, so we're not doing it there at present. ASX, we like this name. It sits in the model. We recognise the stock's expensive at 24 times earnings and a 3.7% dividend yield. Moderate earnings growth. The volatility in the market at the margin helps ASX as a business. The dividend's fully franked, so we see a spot for that in client portfolios. Horizon, we've been cautious on this name and warned of the lower high formation here, and it's one that was spoken about on the short side, and you can see the stock price has sold off following that. BHP, this sits in the model portfolio. Strong bullish momentum here. We continue to see upside value with the stock about 16 times earnings, 3.8% dividend yield. There's further upside likely for BHP. Brambles, a little bit cautious with this name. It's got a negative structure, lower lows, lower highs, and the stock still trades on a high PE, 19 times earnings and a 3% yield. And we think for clients that are holding it, you want to be overlaying a covered call to add additional returns. CBA has been added back into the model at around 12 times earnings and now approaching a 6% dividend yield. The stock just went ex-dividend this week of approximately $2, and we're looking for a more supportive price pattern to begin to develop at or near this current range. Not doing there in Computershare at the moment. CSL came out with a terrific earnings result, but the stock is expensive, 34 times, or on forward earnings, about 29 times earnings, and about a 1.5% dividend yield. We can see there that it's been sitting in the model portfolio for a while and continues to make the higher highs and higher lows. Caltex, bit cautious here, and currently the stock's not in the model portfolio. Dexus, so this stock is in the model, and we can see there the higher low formation. Dexus trades on about a 5% dividend yield. Fortescue Metals, this is stock that's sitting in the model portfolio at the moment. We can see support there at around $4.50. Goodman Group sits in the model portfolio, 17 times earnings, 3.5% dividend yield. This has been one of the better performing stocks within the yield sensitive area of the market following their recent earnings update. GPT, this has underperformed a little, and I think investors should keep an eye on this one for approaching oversold levels. So down here, look for the short-term momentum indicators to start to turn a little bit more positive, and the expectations for the market now is that GPT only delivers about 3% earnings growth, whereas previously it was sitting up at around 6%, and that's partly feeding into this sell-off that we're seeing in GPT at the moment. But we expect us approaching oversold levels. Insurance Australia Group's been one of the best performing stocks the earnings season so far. At 20 times earnings, 4% dividend yield, but the company has terrific insurance margins running at about 17% opposed to, say, Suncorp at 12, QBE at 8, and we'd expect Insurance Australia Group at around $8 the stock's full value for the next 6 to 12 months, but the momentum's there from an earnings growth perspective, where we may be in for multiple years of price expansion there in IAG. Intertech Pivot, it's in the model portfolio. We have the stock trading about 16 times earnings and just over a 3% yield. James Hardie, we don't hold this one at the moment, so you can see there it's got the active sell signal in it. Lendlease has been added to the model portfolio at 12 times earnings and a 4.2% dividend yield. Mirvac Group sits in the model at the moment at 13 times earnings and 5.5% yield. Probably, Mirvac is a stock that we're not drawn to based on our analysis of the fundamentals, but technically the stock still sits in the model portfolio. Medibank, so it's been a while since we've seen Medibank go through a sell-off, certainly of the magnitude. It was trading around $3.40 following the approval of the roughly 4% rise in premiums, but at 19 times earnings and a 4% yield where it is at the moment, and probably not too much in the way of earnings growth, maybe 3-4% earnings growth. I think owning it here and selling tight covered calls and trying to strip out the dividend and the franking credits and using that covered call strategy to boost the cash flow up to 10 to 12% per annum starts to make a lot of sense there with Medibank. Macquarie, we don't hold this in the model at present. NAB we do. So as I said, all 4 major banks at the moment are in the model. Newcrest, so this is a recent addition, just in December last year. It was added back into the model off the back of this support here at $22, and the stock's gradually starting to head a little bit higher now. Origin Energy, interestingly, across the last week, we've seen all the energy names added back in as well. So Origin, it was initially included off this sort of $6.25 level back in March, and the stock continues to make higher highs and higher lows, and it's had another recent algo signal there at around 8.30, and the stock's pushing higher. We see Origin as probably one of the better performing energy stocks. Orica was recently removed from the model following this lower high structure, and the prices continue to disappoint. We do feel that Orica trades on a high PE at 19 times earnings, a low dividend yield around 2.9%, and the algo engine sort of confirms what we sort of already feel on that sort of fundamental analysis side of it. Oil Search, we like this off this support of around $7, and our preference is still Woodside and Origin, but recognising that both Oil Search and Santos have also been triggered under the algo engine. Qantas, so it's been a bit slow going over the last month or so with Qantas, but at around $5 here, we think the stock finds support and continues to move higher. QBE, we're not doing in QBE at the moment, and we can see the structure's still negative under these lower low and lower high pattern, and it's not until the stock really trades back up, creates a higher low, that we'll see QBE added into the top 50 model. So for the time being, it's on the sideline. As is Ramsay, so we can see with Ramsay, lower lows, lower highs, and it's not until that stock starts to recover that we would add it in an aggressive way. Rio, it's in the model, bullish structure and continuing to move higher. And as the resource names, in particular BHP and Rio, really are continuing to favour this theme that global growth's going to continue to pick up, and the market's looking to keep exposure to these resource names. South 32, Centre Group's a yield sensitive name. We see the sell signal there at around $4.50. We're thinking that this stock's probably approaching oversold levels. We have Centre Group at 15 times earnings on a 6% dividend yield. So at around $3.70, we'd expect it to start to find buying support. Likewise with Stockland, it was recently added to the model, 11 times earnings and a 6.5% dividend yield. We're thinking that it's starting to run into sort of an oversold level. Interestingly, with Sonic, we've held this in the model since October 2016, and it was removed from the model about a week ago. So all our subscribers and clients would have received the notification to remove Sonic from the portfolio, and we've seen the stock roll over. We think fair value for Sonic's probably more around $22.50 to $24. So at around $22.50 will present another opportunity to buy. But for clients that are still holding it, the alternative to selling the stock is selling an at-the-money covered call option and stripping out the upcoming dividend and collecting that option premium to enhance the return. Santos, so we've got the buy signal here on Santos at around $5. Suncorp, so this was removed from the model portfolio last year, and the stocks continued to underperform. Sydney Airports remains in the model. It's certainly testing the support levels at the moment, but we're thinking that this is approaching oversold levels and will start to rebound. As is the case with Transurban at the moment, the market's very cautious on these yield-sensitive names with an expectation that US rates continue to move higher. We think the bulk of the adjustment in the 10-year Treasury, or just in US rates in general, is probably mostly priced in for the time being, and that may create some selling reprieve in those yield-sensitive names. Telstra, the earnings result pretty much came in line with expectations with the market. I think the risk for Telstra is, do we see the special dividend cut, which would remove roughly another say 6 to 7 cents of dividends and drop that annual dividend from 22 cents back down to 15. Now, again, there's no evidence of that at the moment. The earnings growth of the company contracted by about 3%, which probably is enough to see the price action support this current consolidation range around this 350 level. Treasury Wines continues to make higher highs and higher lows, and the recent algo signal there at around 1450s turning out to be a very good signal. Vicinity, lower lows, lower highs, bearish, and that's not in the model at present. Westpac is. Wesfarmers is in the model. So we've seen Wesfarmers disappoint the market with the write-offs around their expansion into the UK hardware. If we look back over the last, say, 3 to 4 years, Wesfarmers has tracked between $39 and $45. So we're thinking that it starts to find support at around this $40 level. And to put some numbers on that, Wesfarmers is at 16 times earnings and a 5.5% dividend yield. And the market's only expecting earnings growth of around 3 or 4%. Westfield, we feel that this is oversold, as some of these yield-sensitive names at the moment. And around 855 should prove to be a good entry level into Westfield. At 19 times earnings, 4.25% dividend yield, and the takeover offer there on the table at around 850, the stock should find support. Woolworths, this had been in the model following the higher highs structure, but was removed roughly in November, and we're still cautious, and we'll be watching the upcoming earnings result with interest here. We have Woolworths around 21 times earnings on a 3.4% dividend yield. The market's looking for about 8 to 10% earnings growth. So we'll just wait and see what that upcoming result looks like and see when Woolworths is next added back into the model portfolio. And there we are back to Woodside. So just keeping in mind with Woodside, they're doing a discounted rights issue at $27 and the stock will relist on Monday. We think that's bullish for Woodside, and we're expecting sort of ongoing positive momentum in the oil and gas sector. So I think Woodside's a stock you want to keep a close eye on when it relists next week. And there we are back to the index. So just to conclude with the short-term market outlook, we remain reasonably bullish on those stocks that I've highlighted in today's recording, where we're focusing on that positive momentum structure that where the stocks sit in the model portfolio. We're recognizing that the volatility's picked up in global equities, and there's going to be a bit of a retest of investor nerve as the Dow Jones runs into that resistance, which is roughly around 50% of the range that it's sold off at the moment. Just to have a quick look at the model portfolio button, so let's just quickly review. So in the top 20, the recent additions have been CBA and Westfield. If we have a look at the top 50 model portfolio, the recent additions have been Santos, the oil search, so these are the oil and gas names, CBA. So it's interesting that the banks and the oil and gas names sit in the model, so does BHP, Rio. Newcrest has been added in, along with Amcor, Qantas, and a few other names. So if you're not an existing user of the or client of the software and you'd like to trial the charts and watch list, just visit investorsignals.com, and I look forward to speaking again next month. Thank you.